Hi, my name is Doyle Schuler, and in this video we're going to talk about investing for dummies or investing for newbies. So it's not a slight on anyone, but investing is a very challenging, difficult game. So let's take a look at this and say why the average person is absolutely horrible at investing, and there is a really clear reason for that. And at the end of the video, I'm going to talk about how the Barefoot Retirement Plan can help. So just how bad is the average investor at investing? In a word, absolutely terrible. You probably heard of BlackRock, and they did a chart of the week several years ago, and they found that the average American investor is so bad that they managed to underperform every single major asset class in the world for the past 20 years that they did this study. They even managed to underperform inflation. So take a look at this chart. If you start over in the far right, you'll see where, and this is between 1992 through 2011, that's when BlackRock did this study, and they found that the average investor only generated an average annual rate of return on their investments of 2.1%. And it goes on up. You can see from homes and inflation's there at 2.6%. It goes up. You can see gold and stocks and oil. And then the plan I'm going to tell you about in a moment actually outperformed them all. So the market volatility is usually the catalyst for making poor investment decisions at just the wrong time. This is true for any investor, even a seasoned investor, but much more true of new investors, newbie investors who aren't that seasoned and experienced in that. So here's what happens when the financial markets are moving up or down rapidly, and when there's significant high and low points, emotional instincts kick in, and they drive investors to make poor decisions that make no rational or logical sense at all. Most investors consistently take the wrong actions at the wrong times, and they do it over and over. There's lots of studies and research on this, and at the end of this video, I'm going to show you how you can get a totally free book that goes into this in a lot more detail. So what happens, and this actually goes back to the caveman, and this is kind of DNA coded in all of us human beings, but fear and greed are huge psychological drivers, and they often translate into very poor timing of buys and sells when it comes to investments. And as a result, the average investor has underperformed most asset classes for the last 20 years. And as we said earlier, the average investor doesn't even beat inflation. They come in, they lose 0.5% of their investments over inflation each and every year. So here's the big and important question. If the average investor can't even keep up with inflation, then how in the world are they going to be able to build a large enough retirement fund to take care of them when they retire? And the truth is, they aren't, they can't. The average American investor is woefully underprepared. Some studies say that 65% of Americans say that they will not be able to retire. They'll have to keep on working because they don't have enough saved for retirement. Most people lost in the last several big market crashes. They lost huge amounts of their retirement income. They got scared, and then now they're producing little puny, tiny returns. So here's the thing. What if I could tell you that there's a way, an easy way, to take all of the negative effects, the emotional instincts, and the psychological factors that cause the average investor to perform so poorly? What if we could take that out and completely get rid of that so it's not an issue at all? Could it really be that easy? Well, let's take a look. So many of the Barefoot Retirement clients select an index account. That's what we recommend. The account is guaranteed in writing not to lose a single penny due to market declines. There is a floor and there's a cap. So the floor is 0% and the cap is 17. So the returns are based on the performance of a blend of indexes that's primarily made up of the S&P 500, but it also includes other indexes such as Barclays Capital US Aggregate Bond Index and a handful of other indexes. Okay, so for example, let's say the market goes up 20% in a given year. That's great. Your returns would be capped at 17%. So you might say, man, I got gypped out of 3%. Okay, however, let's say the next year the market went down 20%, then your returns for that year are zero, but you did not lose money. And that's a really, really big deal. Losing money can absolutely destroy your retirement dreams. Your account value stays the same and you don't lose a single penny during a market decline. This strategy completely takes the emotion and the decision making out of the process. So based on the actual historical returns of the blended indexes that we use and maintaining the floor of 0% and a cap of 17, if the average investor would have selected this option, and if they just would have done the set it and forget it, right? They just open it up, selected to use this blended index fund, and not did anything, not worried about making any more buys or sells or trying to time the market, then their return would have averaged 9.28% annualized return each and every year. That beats out all other asset classes analyzed during this BlackRock study, and you would have done it without any market risk and without any stress. Now, obviously, past performance doesn't equal future results, and no one knows what the future will bring. And, these were just because it did that for the last 24 years, we have no idea what it can and will do going forward. But it's pretty good look back is pretty much the only way you can look at the future, or the best way to look at the future is see what things have done in the past. So why in the world did this simple set it and forget it method work so well over that 24-year period? Well, most important reason is that it never lost money due to market downturns. I'm sure you've heard of Warren Buffett, America's #1 investor. He has 2 rules for investing. Rule number 1 is never lose money. Rule number 2 is refer to rule number 1. Yet most investors do lose money, and they lose it. They do a pretty good job of losing it. They get scared out of the market, and they sell low, they buy high. They're influenced by greed when the market is flying high, and they buy high. And sadly, it's the worst possible thing for them to do. They make the worst decisions at the worst time. So the Barefoot Plan takes the entire emotional decision-making process out of the equation, and that's why we beat all of the other asset classes. And imagine how much better you would sleep if you knew 100% for sure, beyond a shadow of a doubt, that your retirement funds, your nest egg account, could not lose a penny during market declines. Let's say there's a terrorist event or a war breaks out or some catastrophic thing happens. You wake up in the morning and the stock market has crashed and your retirement funds are cut in half. You don't have to worry about that. You have a zero floor, so you can never lose money whatsoever. So even though no one knows what the future brings, seems pretty obvious to me with a plan like this, if it beat out over this 20-year period every other major asset class, that it at least warrants some further investigation to check it out. So I wrote this little book, has a funny title, Why You Suck at Investing, and it goes through all of these details and it tracks back why the average investor does such a poor job and gets such poor returns. And it also has more information on the Barefoot Retirement Plan. So you can go to the link, and the link, it's kind of a long link, but it will also be below this video, so you can click the link in the description box below the video and be taken right to the page to download this book completely free, no strings attached. And if there's another book called the Barefoot Retirement Plan, and if you just go to the Barefoot Retirement, you can download that book there as well. So thank you very much. Get the book, learn some more about this great plan, and we hope it can help you. And if you have any questions or if we can do anything to help you in any way, we would be delighted to. Thanks so much, and we wish you the Barefoot retirement of your dreams.